In the last 7 days, I've helped 3 different business owners across 3 different industries get access to over $500,000 in business credit and working capital. In this video, I'm going to break down the exact issues that they were facing that were keeping them from getting access to funding at scale. And I'm also going to share with you the exact models that we ran them through to help them get to the other side. Now, the 3 different industries were real estate and construction, trucking, and e-commerce. 2 of these businesses are experienced, meaning they had already been operating for a couple of years, but the 3rd business, which is the last one, was a brand new business that was just starting from scratch. So let's get right into it. So there's essentially 2 big issues that I see that a lot of people face whenever they're trying to get access to funding for their business. The first one is they think that just knowing which banks or which credit unions is enough for them to get access to capital. Now, that's only telling part of the story, which naturally leads me into the second problem in that since each business is different across industries, the age of business, and even credit profiles for each business owner or anyone that's involved, there's no one size fits all for the type of product that each business is going to need or that's actually going to get approved for. Starting out with the first business that we helped get access to, and that industry was real estate and construction. Now, the way that they originally had it set up is they had both real estate and both construction happening at the same time. Now, while there are instances where you can maybe merge that and bring that together, in this instance, we had them separated. Here's why. They kept getting denied for business credit, even though they were bringing in just over $250,000 a year, right around 260, and they had already been operating and in business for just over 3 years. And so you're probably thinking, wait a minute, with someone that experienced and someone bringing in that type of revenue, you would think that they would get approved for business credit. But here's where the rubber met the road. Number one is the name that they picked for their specific LLC was running into a high risk. Remember, they were doing both real estate, so they were doing both fix and flips, and they were also doing construction. The issue is that on the LLC, they had the word flips in there. So similar to having capital, similar to having life insurance, some of these screen red flags to the banks. And the second bottleneck and issue that they were facing is that their addresses weren't matching. So remember, they're essentially running 2 different businesses. But the issue is that they have 2 different addresses for each business. One is construction, one is real estate, even though it's inside of the same umbrella. And so one of the things that I had them do was a business address audit. And one of the things that I have our clients do is I want them to look at 4 different sections inside of the business address audit. Same thing happens with name changes, which we'll get here in just a second. And so the first thing is going to be you want to look at it from a federal level. So that's in the eyes of the IRS. Secondly is you want to take a look at it at the state level, which is maybe inside of, let's say we're dealing with Florida, inside of Sunbiz. The third area or third pillar that you want to take a look at is at the banking level. So let's say you're banking with Bank of America or Wells Fargo. You want to make sure they have an audit there, everything matches. And then the 4th area that you want to put an audit through is going to be at the bureau level. So if you already have some type of credit established for your business, then you're going to want to check out Experian Business, Dun & Bradstreet, Equifax, and even some of the other smaller business credit bureaus. First things first, the name change had to happen. So the name change happened. What ended up following after was a split with the construction company and the real estate company. Now remember, this is case by case, so I'm not recommending this for you. Speak to your attorney, speak to your CPA. But in their situation, it made sense because they were bringing in enough revenue on each side of the board. So each could have been vertically integrated. And now both businesses are positioned in a way where they can each get access to their own routes of funding because now they each have their own EINs, they each have their own business bank accounts, and they each have their own business credit scores. So after making those quick changes, this business was able to get access to over $140,000 worth of business credit. Now, the second business was involved in trucking. Their set of problems were a little bit different from the first business. Let me explain. The first thing that they had going against them was the way that they were bucketed and the way that they were classified to the eyes of the bank, to the eyes of the bureau, to the eyes of the IRS was seen as a high-risk industry. This may sound kind of like what's happening with the name, but it has more to do with the reclassification, not just the renaming of the business. Remember, the first business that we dealt with was more on the renaming side. This business issue or this business funding issue was more on the reclassification side. The second issue that they were running into is that even though they had strong personal credit, it was 2 co-founders, so they both had strong personal credit that they can each personally guarantee on behalf of the business. They had no issue doing that because they have strong credit, they have great revenue. Their business credit, now that they're finding out that more of the banks that they want to work with are running dual scores. What does that mean? That means that they are taking a look at both the personal credit. So let's say they're taking a look at personal Experian and they're taking a look at the business Experian. And so now they're averaging both score. SBA tends to do this a little bit more, But now with climate starting to tighten up a little bit more in the lending space, we're seeing that happen a lot more within banks. So the way that we help them overcome getting access to weak limits and getting constant denials was we help them get access to the right sector. Now, if you've been following this channel for some time, or if you've been watching business credit content, then you're probably thinking, oh, they probably picked consulting, or they probably picked logistics. You always want to pick the exact NAICS code or the exact industry that fits your business model, because you have to be able to back it up later on. Can you get away with getting access to maybe a business credit card here too? Yeah, but that's child's play. You want to get access to the big boy, big girl lines of credit, business term loans that are going to require you to back up with your documents of, hey, this is the type of business that we do. These are the articles of organization. This is the articles of incorporation. This is the industry that we're involved in. These are our tax returns if you wanted to get access to some bigger lines of credit, right? Don't be afraid to throw around some financial documents if it means you're going to get access to an extra $250,000, an extra $200K in funding. The first thing that we had them do, or the first solution rather, was we got to reclassify it. And so we had them pick logistics, but not any logistics with the proper management in transportation. A lot of people say, well, just pick logistics. Well, what type of logistics is it? Is it airline logistics where you're airing things out? Is it shipping logistics? Is it freight line logistics? Is it trucking logistics, right? So you want to be able to tell a story in the event that the underwriter asks you, hey, I know you're in logistics, but what type of logistics is it? When you reclassify your business properly, it now lowers the threshold that your business is seen as maybe a business that's going to default based off of the average in that industry. And then also it can give you a bigger cap of how much they can lend out to you, because now you can be perceived as a bigger fish in a smaller market versus a lot of games that a lot of people are playing where they want to pick maybe an NAICS code that's super popular, but guess what? Everyone's fishing in that same pond. So now you're a smaller fish in a bigger market, which means you're going to get less of the pie. And more often than not, if your business isn't structured right, especially if you're a newer business, banks are going to take a look at the older, more established business versus the newer startup. It's just the name of the game. And with these changes implemented, they were able to get access to over $310,000 in business credit. Now, the third and final business that we helped scale was a complete startup, and this was e-commerce. So let me lay some context down for this. This means that this person, as a matter of fact, was still working at their day job. They had just finished opening up their LLC 90 days prior to when we started working with them. So there was no business revenue being generated. They just started a website. They were just starting to pick out their products. So they had a little bit of testing done. They just needed to now dump revenue, or rather capital, back into the business because they kind of already had a working model that they had tested with smaller money, but they now wanted to just open up the floodgates with funding to then scale their revenue. So if you're a startup, you have no taxes, you don't have any financial documents, this next section is for you. There's 4 different things that we had them implement that was technically a disadvantage, but we helped them use it to their advantage. First one was taking a look at no-doc programs, which I also like to refer to as app-only or stated income products. Think of this as if you put on an application, let's say a 0% business credit card, they're typically, which most people don't know this, but they're typically going to look at projected revenue. Now let's take that a step further. If you're taking a look at your projected revenue within your specific industry or within your specific demographic, which in this case it's more online, so you can kind of go off of a national average, you have a higher margin that you can play with. And so let's say if the average is right around $120,000, right? Because obviously we got big players in the e-commerce space and we have maybe lower entry, then you know comfortably you can play around with, hey, my projected revenue is right around 100K. Can you push out a bit more? Yes, but here's like a little bonus or a little side step that I tell my clients is, if you have a business and you don't have any revenue just yet, and you're just maybe working off of the projection of a revenue, you always want to do it at the state and at the local level. Here's why. If I'm running a landscaping business inside of California, the projected revenue on that and the average revenue inside of maybe Orange County or inside of LA is going to be totally different from someone in the middle of Iowa or someone in the middle of Wisconsin. And again, due to how early this entrepreneur was getting involved in the e-commerce business, they had to leverage their personal credit, which means though that they had access to a business relationship because they had already been doing business just on the personal side. So all they had to do was walk back into the bank, which I typically tell my clients as well, hey, walk into the bank. You already know people there. You've been rubbing shoulders. You've been having conversations. You've been kissing babies, right? Go in there and talk to the banker that's been helping you get set up to this point. more often than not, they can either take care of your business file, maybe help you open up a merchant account, maybe help you get access to that first business credit card at 0% interest, which is where most small businesses are going to start, or they can point you in the right direction to maybe someone in the business division inside of the same branch. And then the last thing that we had them do was, hey, since you still have a day job and since you have a spouse, you guys can use your total household income, HHI, your household income, to put that on an application, because those are actual figures that you have to work off of. So now you have a combined income going inside of a business credit card application, which is on the personal side and on the business side. Remember, there's two parts of a business credit application. If you haven't seen that video, highly recommend that you check that out. I'll probably link that somewhere in here, that you can use those numbers as leverage. And once we put these final pieces into play, they were able to get access to over $85,000 worth of business credit that they're now using as a complete startup to continue to scale their business and to continue to scale their products. Those are 3 different businesses across 3 different industries that we help scale to over $500,000 collectively worth of business credit. If you found value in this content, consider hitting the subscribe button down below. Don't forget that anytime I'm not posting on here, I'm posting inside of our podcast, which is Insight with Irv. We have a second channel dedicated just to that. You guys can check that out. If you are looking to become a client and if you need help getting access to business credit and capital, you can book a free demo with my team. The link is down below. I'll go ahead and pin it in the description. It's a free call. See where you're at, where you're looking to go, and see how we can help. Once again, I appreciate you guys checking me out. Until next time, everyone, I will see you in the next video.